All right, we're taking a look at the markets ripping higher. Bank stocks are a big part of that story, as investors believe that Donald Trump could be good for the economy, but importantly, it could mean a more light touch when it comes to regulations. That's true of a lot of sectors, but particularly the bank sector, where they have been quite loudly complaining about the constraints around them. Let's bring in Brenda O'Connor Juanas, who is Senior Vice President and Financial Advisor at UBS. Brenda, thanks so much for joining me. First, let's just take stock of the market. Are you surprised by the magnitude of the enthusiasm around Donald Trump's victory?
Hi, Amber. Thanks for having me. Okay, the world is waking up this morning to a new president in the U.S. after an election night that was much more decisive than I think anyone was expecting. You were talking about the Trump trade earlier. Yes, you can see the market reacting to the Trump victory in U.S. dollar, in Bitcoin touching 75,000. Across the market. Amber, we don't think, unfortunately, this fundamentally changes how we're viewing stocks over the next 12 months. We are positive on stocks because of the Fed continuing to cut rates, because there's going to continue to be durable growth, although more muted in GDP and profit. And so we still have a 6,600 target on the S&P for the end of next year. We like financials, we like utilities that I'm sure we're going to talk about here. Amber, I would say one other thing. No one is uttering the name Powell today for obvious reasons, but the Fed is meeting today. We could have another rate cut by tomorrow afternoon, which will also be supportive for stock.
Yeah, that seemed like an anxiety point because we didn't know if we would know by then if there was going to be an announcement on who was president. I just wonder, though, you said you remain positive on stocks. You see big upside from here on top of what has already been such a strong year. Are we not paying enough heed to the risks associated with tariffs, what that means for inflation, what that means for growth, the risks associated with the bond market that seems to be telling us they're going to put pressure when it comes to exerting fiscal discipline?
Right. Okay. So, of course, we are seeing the fears with tariffs in certain sectors at this point in time. You can see it, for example, in the U.S. dollar. You can see it, for example, in the bond market, even in tech. I would imagine that we could see some soft or weakness in tech in the coming days as the market digests exactly what impact the tariffs will have on sectors like semiconductors. The bottom line is, as in with tech, the broader narrative is still positive. Stocks are going to be driven higher by positive earnings. We still have positive EPS growth going into 2025, and the fact that the Fed cutting rates will continue to be a tailwind. So tariffs, we're still keeping a close eye on, but we think that there are fundamentals still driving this market, Amber.
Okay, let's talk about that as it relates to the financials, because that's the real bright spot today. There's a lot of them, but when do we see Goldman Sachs move by 9%? When do we see JP Morgan move by 7%? Stunning moves on top of all-time highs. Where's that enthusiasm coming from?
Right. I mean, it is just wild to see the performance of some of these huge names this morning. Amber, I've been looking at financials as a bellwether for the last week and talking about it as an indicator of what was going to happen in the election. And look, you can see the positive performance of the Trump victory on financials. More broadly, again, talking about fundamentals, we do think that these rate cuts are going to drive funding costs down. And then you have these other factors like increased capital market activity, which will hopefully be better under Trump, and decreased regulation that is going to really affect the financial sector. Amber, look back to 2016 as an indicator. 12 months after Trump was elected, financials was the top performer. So we have seen financials run, but keep in mind that from a PE perspective, it is still trading below the S&P and delivering better returns. So I still think there's more room to run here in the financial sector.
I'm glad you brought up multiples, because where we are in terms of multiples for the market is significantly higher than we were in 2016. And so that brings me to my question. You see more room to run. Is that all fueled by earnings growth? Does the E come up to meet the P? Or do you expect further multiple expansion?
Well, I do expect a little bit of both, but I think from an investor perspective, this is going to be the reason why sector selection is going to have to matter more. You highlighted utilities. Yes, we have seen some softness in certain subsects of utilities this morning, primarily because, as you mentioned, renewables will not do well under Trump. But this is the sector that, from a PE perspective, is trading below its history, below the S&P. And I still think that there are drivers here that are fueling the U.S. economy that are very supportive under a Trump presidency. That's number one, the reshoring of industrial activity. Number two, for example, the surge of AI and data center growth. This is going to be positive for the sector. It's going to deliver a 3% dividend yield, which is going to be more important as rates come down. So again, investors are going to have to be selective of where they deploy capital to sectors, because markets are certainly not as cheap as they were 4 or even 8 years ago.
Are you a believer in the trade to move down cap? We're seeing the Russell, for example, surge today up 4%. And even, sticking with your financials theme, the regional banks doing extraordinarily well. Where do you want to be positioned?
So I think quality is important. So across the board, I am focused on quality with durable earnings. But to your point, small mid cap could perform well. Again, this is under a Trump regime. But remember, Amber, it all tacks back to the Fed. The majority of small cap companies have floating rate debt. Again, let's see what Powell does tomorrow as the Fed continues to reduce rate. This is going to alleviate a lot of pressure on those small cap companies and their floating rate loans.